Welcome to the deep dive. Okay, so last week, wow, market sentiment just did a complete 180, didn't it? And it all seemed to hang on just one speech.
It really did, that sudden shift, that whiplash.
Exactly. That's what we're digging into today. We're doing a deep dive on everything that happened between, let's see, August 18th and August 25th, 2025.
And the mission, I suppose, is to figure out this Jerome Powell rally, as you're calling it.
Yeah, how did we go from mixed signals to such a clear market direction? What actually drove the indices and, what does it mean for you heading into September?
Right, because setting the stage, last week was, well, kind of light on the usual big data drops.
Super light, but incredibly heavy on news that really made waves globally.
Absolutely. So we need to unpack the Fed minutes, that really pivotal speech from Chair Powell, and then the market reactions, which were fascinating.
Totally fascinating. From tech kind of stalling out to small cap value suddenly surging.
So, yeah, let's get into not just what happened, but the why behind it.
Perfect. Where do we start? Maybe with the Fed itself.
Right.
Because things didn't seem all that harmonious initially.
That's the perfect place. The Fed minutes came out last Wednesday, and they showed something pretty interesting.
Which was?
Well, the text mentioned an unusually high level of disagreement on rate cuts among the Fed governors.
Unusually high. That jumps out.
It does. It seems most of them were still more worried about inflation sticking around than they were about the job market weakening.
So that classic tension, the dual mandate. Fighting inflation versus keeping employment strong.
Exactly. And that tension makes it really hard to get everyone on the same page about cutting rates.
Yeah.
Hence the, disagreement.
Okay, so we have this backdrop of internal debate, and then Friday, Jackson Hole, Jerome Powell speaks.
The tiebreaker. You could almost feel the market holding its breath.
And his words were chosen very, very carefully, it seems.
Oh, absolutely. He basically made two key points that just shifted the whole feel of things.
What were they?
First, he said, and I'm paraphrasing slightly, that the stability in unemployment and other job market signs lets them proceed carefully when thinking about policy changes.
Okay, proceed carefully. That sounds cautious, but it doesn't rule anything out.
Exactly. It opened the door. And then he added this bit. There is significant uncertainty about where all of these policies will eventually settle and their lasting effects.
Significant uncertainty. Sounds like hedging his bets a little.
You might think so, but the market, it didn't really hear the hedge. It heard the first part much louder.
So how did they interpret it overall? What happened to those rate cut odds for September?
They exploded. The probability of a September rate cut jumped, get this, to 84%.
Wow. From what?
From 62% just the week before.
84%. That's basically the market saying it's a done deal, a huge recalibration based on just a few sentences.
It really was. It just shows the weight his words carry. The market reacted instantly and very positively.
It reminds me of that quote from Ryan Sweet, the economist at Oxford Economics. He said something like, when Fed chairs open the door for a rate cut, it's quite difficult to close.
That's such a great quote because it captures the psychology perfectly.
Yeah.
Once Powell gives a strong signal like that, market expectations solidify really fast.
Right. It builds momentum.
Yeah, and it takes a lot of strong opposing data to make the market change its mind again. It almost becomes self-fulfilling pressure on the Fed.
Okay, so the immediate reaction was huge. But what's interesting is that looking further out, like for the whole of 2025, expectations for cuts didn't really budge much, did they?
That's right. The odds for, say, 50 basis points or more in cuts by year-end stayed pretty stable, around 81%, right where they started the week.
So what does that tell us? The market freaks out about the next step, but has a pretty fixed idea about the longer road.
Sort of. It suggests that while Powell's speech was crucial for nailing down the timing of the next cut, the market's overall view for the year was already kind of baked in.
Like, okay, September looks likely now, but we already figured we'd get cut sometime this year.
Exactly. The speech clarified the immediate chapter, maybe, but not the whole story the market thinks it already knows.
Got it. Okay, let's shift to the stock markets here in the U.S. because things were looking a bit shaky before Friday.
Yeah, through Thursday, markets were generally down, especially tech.
Right. The NASDAQ was off. What was it, 2.4%?
Something like that. It looked like classic profit-taking after that big AI run-up we've seen. Investors maybe getting a little cautious.
And then Friday hit, the Jerome Powell rally.
And it reversed things sharply, a really strong rally. But the interesting part wasn't just the overall lift, it was what lifted most.
The rotation.
Exactly. Small cap stocks, particularly small cap value stocks, just took off.
Cook-off is right. Small cap value was up Wait for it.
Yeah.
4.3% on Friday alone.
A whopping 4.3% just Friday. And if you look since the start of August, they're up almost 10%.
Between 8%, yeah, compared to the S&P 500 at only 3.5% over the same time. That's a big gap.
It really is. Now, these stocks are known to be super sensitive to rate cut news, or even just the expectation of rate cuts.
But, and this is the key point you made, for this shift, this rotation to last, we need to actually see the cuts happen, right?
Precisely. The market's jumping on the expectation. For the performance trend to stick, the Fed has to follow through. It's pricing in the hope right now.
Which explains the weekly numbers then. Large caps, basically flat, down 0.2%. Small caps up 3%.
And growthers actually down 1%, while value stocks gained over 1%.
And the NASDAQ, even with the Friday bounce, still ended the week negative, down 0.8%.
Which leads us to think about that AI rally again. It clearly cooled off pre-Powell.
So the big test is coming up.
Yeah, Wednesday, NVDA earnings. Everyone will be watching that to see if the AI momentum can, get its mojo back. It's a huge indicator for that whole segment.
Okay, let's quickly touch on global markets and bonds. World stocks were kind of,
Pretty much flat, yeah. Developed markets down a tiny bit, emerging markets up a tiny bit. Not much happening on the surface.
But underneath, some divergences.
Oh, yeah, definitely. You saw China rally really hard, up over 5%.
Wow, 5.4%, while Japan actually fell back.
Right, Japan down about 2.1%, coming off those recent highs.
So different things driving different regions. Local policies, growth outlooks.
All of the above. It just shows, even when the Fed makes big news, local stories still matter a lot globally. It's not monolithic.
And bonds. They definitely heard Powell loud and clear.
Oh, absolutely. Bonds rallied, which means yields fell. The 10-year Treasury yield dropped 6.6 basis points.
Down to 4.28%.
That's the market directly pricing in those lower future interest rates, those expected Fed cuts. It's a very clear signal.
Okay, so Powell delivers this strong signal. Market odds shift dramatically. Bonds react. Stocks rally. But it's not over yet, is it? There's still data coming.
That is the crucial point to remember. Powell opened the door, yes. But the Fed always says they're data dependent.
Well, we have some important data points before that September meeting.
We do. We get the PCE price index. That's the Fed's favorite inflation measure this Friday.
Okay.
And then before the meeting, we'll still get the September jobs report, plus the CPI and PPI inflation reports for August. These are all, critical inputs.
The evidence the Fed needs to actually pull the trigger, even if Powell hinted they might.
Exactly. They need the data to back up the move.
So here's the question then. After Powell basically gave the market the green light, or at least a very strong yellow, how much do these upcoming reports really matter now?
Well, that's the fascinating thing to watch, isn't it? I mean, for you listening, consider this. What if that PCE report this Friday comes in really hot?
Or the jobs report is way stronger than expected.
Right. Could that actually make the Fed pause even after Powell's speech? Or is the expectation now so locked in that only truly shocking numbers could stop a September cut?
That dance between the Fed's words and the actual economic numbers.
It's always a dance. Communication versus data. Art versus science, almost.
What a week it was. So, just to wrap it up, we saw a masterclass in how central bank talk can just flip market psychology on its head.
Yeah, Powell's speech dramatically boosted odds for a September cut,
triggering a big rally, especially in those rate-sensitive small value stocks.
While the AI-driven tech stocks kind of hit pause, facing that NVDA earnings test this week.
We saw the power of expectation. But now the focus shifts back to the incoming data.
Which leads to that final thought for you. If those critical inputs like inflation don't quite line up with the rosy scenario the market now expects after Powell's speech, what happens?
How much power does the data still hold when sentiment has shifted so strongly? Does the market narrative overwhelm the numbers sometimes?
It's that constant tension between hard data and market feeling, something definitely worth pondering as you watch the news unfold this week.
Absolutely. Thanks for joining us on The Deep Dive.